All right, everybody. If you hear that cool music, you know it's time for another episode of the 360 podcast series. Welcome. My name is Ed Masterson. I'm honored to be the host for these episodes, and I have a great guest who I'll introduce in just a moment. You all recognize who he is anyway, but let me just tell you a couple other things as well. We are coming to you from one of the 4 state-of-the-art properties here in the Santa Clarita Valley that 360 Executive Suites SCV can offer to you, and I'm talking about a business home away from home, where if you get a space there, in Fred's property, turn that music off. In Fred's properties, it's a great collaborative environment. It's a great place to forge relationships, strengthen existing relationships, and be part of something when you're in that mix every day, knowing that you're connected to the community and all the people that share that building with you. So I would urge you, we're going to put up some contact info at the end of this episode. Make an appointment to drop by whichever property of Fred's here in the Valley, all 4 of them. They're great. This one that we're at today is what I call the mothership of the 4 properties. It's right off the 5 freeway near Lyons Avenue, 25101, the old road. The podcast studio is located here, as well as the relatively new home center, where you can come by if you're thinking about getting into the home purchasing game at some point soon, later, whatever you want to look at it. There's great interactive information up here that you can check things out at your own leisure, get a look at things, and find out some really good information about the potential of buying a home here in the Santa Clarita Valley. Now, in case you didn't realize yet, the 360 podcast series is sponsored by 360 Executive Suites, SCV, and the owner, Mr. Fred Arnold. Fred, welcome to the podcast.
Thank you. We're excited to talk about credit. There we go.
Yeah, the studio audience is super excited. They want to talk about that. So, Fred, we're going to talk about, you wear a lot of hats in Santa Clarita. One of those is you are a mortgage lender. You are an expert in the field of financing people's purchases for either homes or commercial properties. I think today, though, we want to talk about, I believe, home ownership and how credit scores are a huge piece of the puzzle that people may not think about, especially younger buyers, if they don't have the breadth of knowledge that previous or more experienced home buyers have. So talk about that.
Yeah, the system is set up for the more knowledge you have, the better interest rate you're going to get and the lower payment you're going to make. And so if you speak to a mortgage professional, the first thing you want to look at is credit. How is your credit? And that's what I want to talk about today. Real simple. Are you maxed out on your credit cards? That's one of the best tips is, can you get your credit cards at 50% or less of what the balance is? Now, one of the challenges we run into is we get these 0% offers or 3% or, and you might have credit cards that allow you to go as high as, let's just say $30,000, but one credit card is $10,000 max. So you take all your balances and you put it on one credit card, and now that credit card's maxed. Well, if it ever goes above that $10,000, even for a short period of time because of interest, it makes it look like you owe more than what that credit card is. So sometimes that could be a real danger. So having your credit card spread out through several credit cards at less than 50% of the balances is probably one of the biggest keys that people don't realize. Sometimes I'll say, borrow some money from that Uncle Jack that you have just to get your credit cards lower than at 50%. Most kids are responsible and they just have a little bit for whatever reason. So that's one of the biggest keys, below 50% of your balance.
So let's say somebody had $50,000 in credit card debt, and what kind of the scenario you just said, if that was spread out over 4 cards that were approaching the 50% or over for each of those credit limits on each of those respective cards, if they could spread that out over 8 or 9 cards and bring it down so that game that we're talking about, it feels a little bit like a game to do that, but it's smart. How do the credit bureaus that rate you and give you a credit score not see through that, or they don't care because it's really just a matter of here's the metrics we use. As long as you're able to play that game and work it to your advantage, it's all good.
The bottom line is they look at 2 things. One, your overall credit and what percent of your overall available credit, like credit cards, do you have outstanding? So if you have $100,000 in available credit, so that's an interesting thing because some people will close a couple credit cards and now they have less outstandings, they have less available. So that's number 1. Number 2 is the percentage of each card. So they look at both. It's a formula, and it's a formula that's proprietary. And so this is only determined based on a lot of people analyzing it over and over, the experts, if you will, and this is what they tell me. And it changes a little bit all the time. But I've noticed it every time in my own credit cards. we'll make some massive improvements. A new air conditioning unit, $20,000, but my credit limit on one card is $22,000. So if I put it all on there, all of a sudden it looks like I'm almost maxed out on that one card.
Right.
And so that's a real life example where that happens. And we got to make sure that doesn't stay long term, because it immediately affects my credit score.
What about the idea of accepting all the offers that come your way? You made the example of a card that might have a $25,000 limit when you get it, or $30,000. Is it a good idea in this sort of relationship we're talking about on this to accept as many of those as possible and then not use them because that looks like you have a lot of available credit, and relative to how much actual debt you have, does that ratio ever come back to haunt you if you have too many cards with a lot of balance open?
Typically not. It can haunt you if you're not disciplined at credit cards. And it also can haunt you if I set up every credit card to have the minimum payment no matter what come out. Because I'm always going to have enough money in my checking account, even if I'm balancing it from each month, the minimum payment. Because sometimes you'll use a card, and this has happened to me before. I'll use a credit card once for something to keep it active.
Right.
I forgot to make the payment,
right,
but it's set up on auto minimum pay. So I ended up having not a late fee, but I'm having a little bit of interest on that one item, right, because it was on there. So set up all your credit cards on an auto minimum fee, so you never have to worry about that in the case you have 10 cards and you're trying to balance them. Yes, it can be very confusing, but I have one for example, gasoline. I have one for 360 Suites. I have one for my own personal home. I have one for our rental properties. So I use one, so that makes it easier on the accounting side.
Right.
And so as a family, maybe one for the kids' expenses, maybe one for gasoline and cars, one for these different items. One, you're using them, which is not a bad thing. You're getting points. I love the Southwest credit card for the points, by the way, and flying free. And the bottom line is, though, I, as a routine, try to keep it at less than 50%.
So when it comes to people borrowing or coming along and saying, Fred, we'd love to buy a home, what in today's world, what's the maximum credit score somebody can have, a regular person?
So that what we've seen is 850 on a mortgage credit score, okay, by FICO. So 850, and a lot of times anything above 770 is good. Right now, my card or my credit had dropped down a little bit, and I'll bashfully say this, around 710. And let me just tell you another lesson. It was a small collection on a timeshare from like 20 years ago. It was like $1,500, and I didn't pay it by the 30-day because I was going to pay it off. And it went on there. And there's nothing I could do about it. I paid it immediately, but it affected my score for 24 months. And so that was very frustrating. And so the next thing is, anything you ever get in the mail, just either make the minimum payment, communicate right away. So medical, I think of all the time. I get these all the time. Medical for a little blood work. So recently I wanted some blood work. I was doing an Ironman race, and I thought maybe it would be a good idea. And so the lab sent me a bill, but I have insurance. I just paid it, and then because if you miss that and it goes to collections, it's going to lower your credit score. And you think your insurance company is supposed to pay it. Maybe they are supposed to pay it, but they'll give you a refund if somebody else was supposed to pay it. But that $89 or $99 AMR, $100, the $100 fee, the AMR, I did an ambulance ride after a bike ride that I crashed one day. Pay it immediately and then figure it out later, because you're guilty until proven innocent on credit.
Right.
And so collection accounts is the other thing. The other thing I want to mention just real briefly, I had a great client who went through a divorce and now has a new significant other, and I've been doing his loans for 30 years. And his girlfriend, the fiance, her credit score was really bad, like 480. And I'm like, I never seen anything that low. And I said, why have you not made the minimum payment on these credit cards? She goes, I just didn't realize the consequence. I got overwhelmed. I go, if you just pay the $75 minimum payment, and then you can work it out later,
right,
you would have none of these. So we immediately got her to catch up on it. 12 months later, her credit score was able to go up because she started paying things off. But set everything, don't be more than 30 days late on a payment. Even if you're 15 days late and you pay the late fee, if 30 days is the key. That's the key number that goes up on your credit.
Right.
So don't be 30 days late on your credits. Sometimes if it's a one time, they'll waive it. You know, if you've been with them a long time. I always, you know, I've done that before when I was younger. And I was 30 days late. I says, will you please remove it? And sometimes they will, which is great because that's going to improve your credit score. Keep old accounts open and just use. I had a Sears card, and I still have the Sears card, but it's now managed by
Right.
B of A or Barclays. I kept it open and started using it here and there, and I used it for one particular thing, gasoline. And so it was continuing to be used simply because I'd get great offers if I did have to buy something short term, a major expense, air conditioning unit goes out, I'd put it on 0% financing and I'd knock it out as life does still happen, right?
Sure, of course.
So that's another thing. If you're going to shop for a loan, let's say furniture, try to use your local credit union or major credit card for the purchase and not the financing arm of the finance company.
Right.
Because it rates differently if it's with Finance ABC of America.
Mm-hmm.
It's just a different rating because it's a finance company versus a traditional bank. Now, I'm a big fan of credit unions. I love credit unions. I think they're great. They're great for our society. They're great for the consumer. But also some of the regular Chase or B of A cards are also very good. Use that if you're going to have them, but shop for that card or those cards in a short period of time because you're going to have inquiries and you want those inquiries during the same time. That's another tip. And like shopping for a car, try to have, if you're going to go to 4 or 5 dealers, go on the same weekend because if they each pull credit, the bureaus see that you're shopping for a car,
right,
and they're not going to hit you for it.
So all of that's amazing information. And again, you helped us out with a mortgage that we are super grateful for still because the rate is so low now relative to current rates. And here's what I was going to ask you, Fred, because we talked about young people maybe wanting to get into the home buying market. What if somebody comes to you and their credit score is below 700? Is that kind of a non-starter or not necessarily for you to start working with them? Or do you say, look, we need to rehab this up to 720, whatever the minimum is you think is correct, to get a rate that's going to work for them? Do you say to them, look, let's work on this for 7 or 8 months to get you to a certain point? Or can you literally start anywhere with anybody depending on what their credit score is? Can you start the process even if people have lower credit scores?
Yeah, that happens all the time. And, I got to get my credit score before I talk to Fred or talk to a financial advisor, if you will, in the mortgage world. Call us immediately because if we can get you from 6 to 7, it's a little bit better rate. And from 7 to 720, it's a little bit better rate. 720 to 740. So it goes in increments and you pay a little bit less for the loan. Now, on an FHA loan, which is 3.5% down, and some of the rates are really looking good right now, you can go 660 without a problem. And in some cases, you can even go lower than that if it's a manual underwrite or the right investor. And you don't pay as much between a 770 and a 680 on an FHA loan. Mm-hmm. In fact, I don't believe off the top of my head there's even any hit, if you will, or because it's designed for those disadvantaged FHA. But
right,
even if you're advantaged, you can still get an FHA loan. So definitely see your mortgage advisor, see someone in American Family Funding, find out what it is because it's really, really important that you get the whole banking system. The money system's been set up for the banks and the financial industry to make money on you. I mean, it's really simple. And I'll be the first to say, because I use a lot of credit for all of our facilities, it's not built for Fred. It's built for the banks, and it's built for the financial institutions. So if you come to someone like us or other professionals in town, they'll tell you how to get your score higher and how to be able to win easier. And I think that's really an important thing to relay to you is get the advice of a professional, because again, whether it's the way you take your income, it could be the amount of down payment. You know that 10% down, and I don't want to get up, but 10% down, you're only going to pay a little bit more for mortgage insurance than 20% down. And the reason why is there's so few foreclosures that mortgage insurance, if you only put 10% down, it's an extra fee you pay if you put less than 20% down. It's so minor that a lot of people say, I'd rather have that extra 10% to fix up the house.
Sure.
And so the sooner you talk to us, the better, because we can advise you on it. And if you end up not buying it, you have a better credit score to buy other things that you're looking to buy.
What's the one thing that you think scares people off? Like, like we talked about a little bit before we started, purchasing a home, the cliche is it's probably the biggest thing you're ever going to do financially for most people.
Yeah.
What is the thing that scares a lot of people off? And by being scared off or intimidated by the process, maybe due to lack of knowledge, they let a lot of time run off the clock that maybe would have been beneficial to get some advice sooner.
Oh my God.
What scares them off? What is the main thing?
It's the fear of that big purchase. A lot of our generation, let's say our kids, saw us as adults go through the Great Recession, and some people lost their homes, or they saw their friends lose their homes. So they're looking, the younger generation's looking at homes as either an investment or a scary thing, because they saw what their parents went through. And I just say it's not that scary and it's not that hard. How much is your income? And maybe you can get some raises. I mean, my son's a perfect example. He's a firefighter. Mm-hmm. His income's, gone up dramatically as a rookie firefighter than as a second year, third year firefighter, because you get overtime, and it's dramatically different. So he's in a dramatic better position just 12 months later, but he was able to make sure he's ready when he's ready. So I think it's just the myth of how hard it is, that I think go talk to somebody, and by the time you're done in my office for 45 minutes, you're like, that's it? Yeah, just, go for that X promotion, pay down a little bit of credit card, and just save a little bit more money, or borrow from your retirement account. We'll get you into a house.
Well, I got to say, and I'm not saying this just because I'm talking to you, it's true. I think my philosophy in life with people when they're trying to accomplish things in their life is there are a million people in the world that can tell you no for whatever it is you say you're trying to accomplish. Yeah. There's so many people that can say no. There's less people in the world that can say yes. And I would say when it comes to this also, find the people that can say yes. And you said yes to us when I came to you and said, hey, our current mortgage company can't help us. We're trying to get a better rate, et cetera, but I don't know if we can do it or not. And you said, well, let's take a look. And you fixed it and made it happen and got us a new mortgage.
You know what? And that's crazy because, not to get in the details of your transaction, but you got no from 2 or 3 lenders who, if they just shifted this and this and this, done. And it took us like 30, 35 days to do. Mm-hmm. It was just a different way to look at the situation. And I think that that's so important. Find out hang out with people. What did Warren Buffett say? What's the biggest piece of advice you can get? And Warren Buffett says, look around you. Who are you hanging out with? And go get an advisor. You're never too young to get a mortgage advisor, even if you don't have a house. You're never too young to get a financial advisor. My daughter's a financial advisor, and I tell people, go talk to a financial advisor and learn how to save $250 a month in your retirement account as a young borrower.
Yeah.
So you're never too young to get advice, and those that have succeeded will want you to succeed.
And I think procrastination is your biggest enemy, right? For all these things we're talking about. If you as a young person can do what you just said, just start modestly, whatever you can afford, but get in the habit and the discipline of doing it, that I think long-term is where you really
don't be the despair of regret, when you're retired or 10 years from now or 20 years. The good times are now. And now is a great time to think about tomorrow, because it's going to come.
Isn't that what they always said about real estate? When we bought our house, we got the financing through the builder. Yeah. I think our mortgage rate was 19%.
You just shared to all the audience how old you are.
I know, but they can already tell by the way I look. But the prevailing philosophy then, and I think now, is the best time to get into real estate is right now. Yeah. Now I know there's other advice people give you, et cetera, but unless you're a genius or have a crystal ball, how do you know when the exact right time is going to be for you to get into it? So I kind of like that advice, which was real estate is always going to be an appreciable asset. Get into it as soon as you can if you're going to do it. Is that still pretty good advice?
100%. And I know our next segment we're going to talk about, if your payment's $7,000 and you both make good money and you're a young borrower, does it make sense? And what are ways to bring down your payment? So yes, get the advice now, and don't ever have, what is it? Not despair of regret, or don't ever have regret in your life. Find out the information now so you can make the decisions today that'll better your life long term and tomorrow.
I love it. That's a mic drop. I don't want to ask you any more questions because that's such a great thing to end on, Fred, unless you have more information regarding this topic that you want to share with us.
No, we're good. I think we covered it.
You're
Give us a call. We're happy to give you some of these pointers and guide you in the right direction.
You're a one-stop shop. You can help people think about buying a house. You can help them with the mortgage, and you've always got great advice for people. And you've got lots of hats. You're the owner of these properties. You're the sponsor of this show. We appreciate you doing that and letting people come in here and do these episodes to get information out about their business as well. So thank you, Fred. You're a good man.
Thank you.
All right. And thanks to all of you. If you like this interview, or even if you didn't, hit the subscribe button and the like button, and we'll see you on the next one. Let's hear what the audience has to say about Fred today. I think so. All right, you guys. Thank you so much. We'll see you next time out.